Thursday, September 22nd, 2016. Monaco 64 here, home of alternative economics and contrarian views. So we've had the Bank of Japan and the Fed meeting yesterday. They basically didn't really surprise. The Fed, again, wimped out. They did not raise rates. A few weeks ago, people were saying, oh, the rate hikes are on. We've had the same kind of thing all year round. Oh, yes, they're going to raise rates. It will be dependent on data, though, and then the data get worse and they don't raise rates. It's just getting really, really silly. And yesterday, the same kind of stuff. They said, oh, we're not raising rates. We're going to let the economy continue to run. But we will probably raise rates in December. I doubt it. I doubt they're going to raise rates in December. So what was the result of the Fed's action? It wasn't surprising. The stock market, the Dow, went up just under 164 points, or 0.9%. S&P went up 23 points, or 1%. On the bond side, 10-year yield dropped 6 basis points from 170 to 164%. So that means bond prices went up. And the 30-year bond yield dropped 10 basis points from 245 to 235. The dollar also took a hit. The euro rose from a low yesterday of 111.23. And right now, as I speak, the euro is 112. Just below 112.50, so the euro's gone up. The yen is gone up as well, so the dollar's dropped against the yen. We're at 100.64. We were above 102 prior to the Bank of Japan meeting early yesterday. So the dollar's dropped. It looks like the Fed does want a weaker dollar. Question is, will they get it? The other well-performing assets, of course, were the monetary metals. Gold traded from a low after the BOJ meeting early yesterday of 1307 to a high of 1336 yesterday. And right now we're at 1333, 1,333. Silver traded down to 1903 yesterday. We're now at 1975. The high so far this morning is 1990. So everything looks fine now. The central banks are giving the right signals to the markets. Investors seem to be comfortable. But one thing I'd say, I listened to a video or an interview someone a few weeks ago, and they're talking about, central banks are not omnipotent. They do not control the market completely. They can influence the market, and right now, investors and speculators are still giving central banks the benefit of the doubt. And one thing to explain why central banks don't control the markets. There are a lot of people out there who say the markets are rigged, the central banks have killed the market. But I wouldn't rush to that conclusion. I've looked up here research by Global Economic Briefing Central Bank Balance Sheets by Yardeni Research Inc. Dr. Edward Yardeni. I'll put the link below to this page in the description. And according to Dr. Yardeni, if you add up the assets of the major central banks, which are the Fed, the ECB, the Bank of Japan, and the People's Bank of China, you get a total of $17.6 trillion in total assets of these central banks. And that was as of August 2016 for all of them except the ECB, which was June 2016. But so basically you got $18 trillion of assets held by the central banks. And then I looked at a story that came out last year in February, and it talks about, it's on Market Watch. I'll put the link below as well. It talks about global financial assets. And as of 2014, the estimate of the size of the global financial markets or assets is 294 trillion. So you could argue that by now we must be above 300 trillion. So if you think the central banks can control a market, that's, let's say it's 320 trillion by now, and they've got 18 trillion of that. The market is 18 times bigger than the central banks, the major central banks. So right now, the central banks are in control. They are influencing the markets, and the markets are behaving, I guess, as they want to. The world, the real economies of the world are not doing well. You can see by the statistics, even in the US, where the government and their agencies manipulate the data, not only in the US, in the UK as well, and everywhere else, they're not even able now to manipulate it to show a strong economy. The US economy has been growing at around 1% rate this year. So, they're trying, to influence the market. So in my opinion, what I would say the central banks are doing, they're, let's say it's a summer, really hot summer day, 100 degrees Fahrenheit, or over 30 degrees centigrade or Celsius, and the central bankers come out because people are not going out because it's so hot and humid, and they want to stay in their house in the air conditioning. So the central banks come out and they put a thermometer out, and they put some cold water. They put the thermometer in cold water, and it reads 22 degrees centigrade, 70 degrees Fahrenheit, and they tell the people, you people should get out. Come on, it's not hot. It's only, 70 degrees. Go out and do something. Go shopping. Go spend. And then people go out, and then they're halfway to the mall or the shopping center, and they realize, what the hell are they talking about? It's too hot. I'm going to go home. So that's where we are. We've had 2008, the thermometer went way up in 2009. And the central banks had to do something. So what do? They started all these irrational, irresponsible policies of money printing, low interest rates, zero interest rates. Now they're talking about negative interest rates. And there are a lot of people in the alternative media who say, or even in the mainstream, who are now against these policies, they say, oh, they did the right thing in '08. They had to do QE. I'm sorry, they didn't have to do QE. Even then, they had to allow the system to collapse or the market to clear the system. They've been manipulating the thermometer or the barometer since they started interfering after the collapse of *08. And I would argue that the only market that they have, bigger control of, and is the most important market, are the monetary metals, gold and silver. They're very small markets compared, to the global financial assets of over 300 trillion, but they are the barometer of monetary and financial health. So the central banks have been able to keep that thermometer or barometer in check, and people, investors and consumers, they're being fooled. And soon they're going to realize on their way to the mall or the shopping center that things are not well, and they're going to run back home. And when that happens, we will see, the markets take over and the influence of central banks wane. When that's going to happen, I have no idea. There is a lot of talk about October 2nd, October 3rd, which is the end of the Jewish year and beginning of the new year and the Super Shemitah, the Chinese yuan being added to the SDR basket. There are all these talks. I even saw yesterday an article in the Telegraph by Ambrose Evans Pritchard, who's an economics and markets writer. He's quite well respected in the city of London. People read him. And he noted that UNCTAD, which is a UN trade and development agency, is now saying that globalization has failed and that the world needs to go through a debt jubilee. Look, I don't think the UN is a good institution. The UN headquarters in New York was financed by the Rockefellers. But we don't know when this is going to happen, when the markets are going to wake up and see that things are not well, and people are going to realize that the central banks have been lying about, financial, monetary, and economic health. So as of now, as of this morning, it's around 9:30 London time or 4:30 a.m. New York. The markets are still, they believe in all of it. The Dow is at 18,300. The currencies are fairly steady. But how long will it last? When will people realize that the thermometer or barometer has been tinkered with? So if you enjoy my videos, please like, share them, and subscribe to my channel. And if you'd like to donate to my channel as well, there's a few links below in the description. You can donate in cryptocurrencies. You can donate to PayPal or Patreon. Thanks for watching. Take care.